So what I plan to do in today's session is give a holistic approach. So the title that we have is changing and emerging scenario and valuation strategies. So my plan, friends, is to give a holistic approach, holistic view. So we would start with the lessons of from 2020. What is purpose of valuation? That is what we would discuss. I'm sure this is a question which is very common and must be known to all of you just like this. What is the role of valuation as a profession in the economy? We really need to be very clear about it. Then we come to changing and emerging scenario and how the scenario, economic scenario or the scenario in this country is changing or globally it is changing. We look at that. Challenges in changing and emerging scenario. So what are the challenges that we have to overcome in our profession as valuation professional? Then we will look at some of the specific challenges that relate to the valuation per se. Then we look at, friends, future of valuation profession, and which in my view sky is the limit. So how is the future for the valuation profession? That is what we would look at. And finally, we will look at the valuation strategies in changing and emerging scenario. So friends, this is what is the plan that I have. Then of course we will have the question and answer session at the end of it. And I intend to leave enough time for all of us to have enough question answer session. And so this is, friends, what I intend to do. Given a choice, I would always like, or I always love to make my sessions interactive, but then we are in a virtual world, and virtual world has got its own limitations. And one of the limitations that the virtual world has is interaction sometimes becomes a bit of a challenge because for whatever number of reasons. But doesn't really matter. I will ensure that at the end of the session, I have enough time at my disposal to take care of all your questions, and I would try my best to answer them. Let's begin, friends, from the beginning. And now, lessons from 2020. Now, friends, I'm sure many of you must have heard of people say that 2020 was a bad year. 2020 was an year to be forgotten. Now, really speaking, there is nothing a bad year or a good year, because time is time and time is always same. What can be different is different situations, different circumstances of individuals. So really speaking, 2020 was not as bad a year as it is being made out to be. As a matter of fact, if we look at it very thoughtfully, we would realize that 2020 is one year that has given us tremendous lessons, many useful lessons. The only thing is we should not waste this opportunity. In my view, as of now, as I can see, friends, the worst is over, and we can see it happening all across. So the worst is over. What are the lessons the 2020 has given to all of us? Just to share with you, the lesson number one is, in life, anything can happen. We need to be prepared for it. That is lesson number one of the year 2020. Do not take life for granted. It's the most precious thing that we have, is the lesson number two, and we have learned it in a very hard way. Lesson number three, making this world a better place to live is everyone's responsibility. Making this world a better place to live is everyone's responsibility, including you and me. And as a matter of fact, we professionals have even bigger responsibility in this task of making this world a better place to live. And why do I say this? I say this because we professionals, whether we are cost accountant or chartered accountant or company secretaries or lawyers or MBAs, we have a distinct advantage. And what is the distinct advantage? The distinct advantage that we have is that we understand the situation much better than a person who is not a professional. And therefore, it becomes additional responsibility on every one of us that we play that role in making this world a better place to live in whichever way possible. So friends, these are the four lessons that I think 2020 has left us with. I'm sure you can add many more and make advantage and take benefit of them. Coming to the second point, purpose of every valuation. What is purpose of every valuation? Now, given a choice, if we were to face, I would definitely have loved to ask you this question as to what do you think is purpose of every valuation. And friends, if I can tell you in very simple words, in my understanding, the purpose of every valuation doesn't really matter as to where are we doing, doesn't really matter as to for what industry we are doing, doesn't really matter as to what asset we are doing, doesn't really matter as to who is doing, doesn't really matter as to for whom it is being done. The purpose of every valuation is very simple, and that purpose is to find fair value. Period. So the purpose of every valuation is to find fair value. Fair value of an asset or a liability, no matter how do we do it. No matter how do we do it.
Hello.
Yes, please.
Sir,
Yep.
actually, sometimes your voice is getting interrupted. I don't know whether it is for me or others also facing the same issue. Maybe few seconds you are gone and you are coming back.
I see. Okay, so maybe now, unfortunately or incidentally, this must be the problem because of signal. I hope not everybody is facing this problem, and I hope it's only unique to you. So that, and I hope that it should become good for you as well. Sandeep or anybody else also facing this kind of a problem, please?
No, sir. At my end, it is fine.
It's fine. Okay, very good. So if it is fine at one place, I suppose it should be fine at most of the places. So maybe this must be a unique situation at your place. Just be with me, and I'm sure it should be all okay. So friends, we were discussing the purpose of every valuation, and I'm discussing this question with a definite purpose. And why I'm discussing this question with a definite purpose? Because I have seen in our interactions on different groups, WhatsApp groups, where there are valuation is the theme. Now, many times there are queries coming in that this is what it is, which method should I use? This is what it is, which technique should I use? Which approach should I apply? Now remember, all those questions will get automatically answered the moment you and I understand that the purpose of a valuation is to find fair value. The purpose of valuation is to find fair value. So the methods which are given, the approaches which are given is a bouquet. And we have to pick up the one that will help us to find out the real fair value of the asset or the liability which we are valuing. And the moment you have this clarity in your mind, that I need to find out the fair value. Fair value meaning what? Fair value meaning something which is fair to everyone, which is the real value of it, which is the real value of the asset or the liability that I am trying to value. Now that once a person has that clarity that the purpose of the valuation is to find fair value, the doubt about the method, the doubt about the approach is all gone. Because what you need to answer yourself, if I have to find out the fair value, which approach in this situation would be good? Will the income approach be good? Will the market approach be good? Or will the asset approach be good? If I have to do the valuation, which method would be okay? Will the income capitalization method be okay? Or will the DCF method would be okay? Now, I have to find out the fair value. So what discounting rate should I use? Can I just pick up a discount rate just like this? Or do I need to really think about it and find out as to which is the more appropriate discounting rate in this case? So all those questions, friends, in my experience are answered the moment you have a clarity that what I have to do is I have to find out the fair value. And that is what we have to be very, very clear. Now let me tell you, friends, at this point in time, we do not have to work out the value that the client is asking. The moment you try to work out the value which the client is asking, then there is a problem. Then there is really a problem, because the moment you're trying to arrive at the value which the client is asking, the fair value is gone. And if the fair value is gone, the valuation is not required only, because then you might as well fix it without doing anything. So that is the point number one. what is the purpose of every valuation? Purpose of every valuation is to find out fair value. And remember, we are there as professional. Why we are there as professional? Because only a professional will do a professional job. Only a professional will understand as to what is the fair value. Only he would insist on fair value, meaning fair value. Nothing else. Neither this nor that. Only what is fair value. All questions as to which method, which approach, which premise, what cost of capital, what discounting rate, everything will get automatically answered the moment we have this clarity as to what is the purpose of valuation. And the purpose of valuation, as I said earlier, and I'm repeating it once again, is to find fair value. And friends, I am sure all of you must have read about Index 113. All of you must have read about the indices per se, and you will realize that constantly, every time, in all these standards, there is a focus only on fair value, only on fair value. So what the standards are saying, or what everywhere everybody is saying, whether under Index or in IFRS, what everybody is saying is fair value. Nobody is saying find out the value which the client is asking for, or find out the value which you think is which you think you want, you should have. No, our job is, our purpose is to, or the purpose for the valuation is to find out the fair value. The second question, friends, before we come, because I really wish to make it a very systematic discussion. And the second question that I would like to discuss with you is, what is the role of valuation profession in the growth of economy? Now, how is that the government thought to bring out valuation rules 2017? How is that the government thought that now the rules should be replaced by a new set of law, by whatever name it may be called? And they accordingly have also already brought out the draft valuation rules, the draft valuation bill. I am sure all of you would have gone through that draft valuers bill. All of you would have submitted all your suggestions and your recommendations as regards to that bill. So the question is, why the government is doing? Is it that before 2017 the valuations were not happening in this country? Of course valuations were happening in this country, but the way those valuations were happening were really not in the manner in which any prudent government would like the valuations to happen. I'm sure you can very easily understand. Valuation can be used for all kinds of wrong practices. Valuations can be used for siphoning money from the country to outside. Valuations can also be used for all kinds of wrong practices, And if the valuation can be used for all kinds of wrong practices, obviously it becomes the responsibility of the government of the day to ensure that there is a systematic development of the valuation as a profession. And that is how the government of India has brought out the valuation rules, and now in the process of also making a legislation as far as the valuation is concerned. It means what? It means you and I, as a valuation professional, has a tremendous responsibility on our shoulder. Friends, I am sure many of you must have been in practice for decades already, and you would know that this is the first time, or rather second time, that the government of India has given a responsibility on the shoulders of the professional, because the government thinks that the chartered accountants, cost accountants, company secretaries, MBAs, all these finance professionals, they will be professional in their approach, and they will be able to ensure that the valuations in this country are done in a manner that there are no wrong practices. Valuations are done by the cost accountants, cost accountants, chartered accountants, company secretaries and MBAs who have passed the exam, and they do the valuation in a manner that they really find out the fair value and there are no wrong practices happening. And that means there is a good development of good corporate governance. Now this is the responsibility that the government has put on the shoulders of all of us as valuation professionals. And that is what we need to remember. So we need to look at the role of a valuer not me or our role as a valuer, or we should not look at, or we need not look at the valuation as a profession merely as another stream of cash flow for us. We need to look at the valuation as a profession, as an opportunity for us to make an impact on the economy of this country. And I'm sure you can very easily understand this. The valuation that you and I would do will help our client to take a good corporate decision. And when he takes a good corporate decision, what is going to happen is that company that he would set up, or that business that he would acquire, or any other activity will be producing goods or producing services. Those services, those goods would be directly contributing to the economy of this country. And remember, when the client's business is adding value to the economy of this country, that means you and I indirectly are contributing to the growth of the economy through our valuation assignments. So that is the role that we need to keep in our mind as far as the valuation profession is concerned. So valuation role is to be a facilitator in decision making by the corporates, undoubtedly. So that is the role that we have as a valuation professional. That means to ensure that with our valuation we help the clients to come to a good corporate decision, and also to act as a catalyst for improving good corporate governance in this country. Now this is, friends, is the second question that I thought I would answer as we move forward, and that is, what is the role of valuation as a profession in the economy of the nation? Shifting to changing and emerging scenario, and this is what we need to remember all the time. As I said earlier, in the context of the lessons that we have learned from COVID, one lesson that we have learned from the COVID, that in life anything can happen anytime, and therefore we need to be prepared constantly for anything that can go wrong anywhere. And why is that so? That is because, friends, today we are living in a world that is called as VUCA world. VUCA, V for victory, V for volatile, U for uncertain, C for complex, and A for ambiguity. VUCA world. That means we are living in a world which is VUCA, completely volatile. Completely volatile. You can't predict anything for sure that this will happen only in this way. No, definitely not. Uncertain. We have seen with COVID. COVID is one extreme example, but there are so many things which are so much uncertain in our day-to-day life, in business as well as in personal life. So it's uncertain, complex, and things are so complex today. And I'm sure when you sit for valuation, you always have the complexities as to how do I factor the COVID into my valuation. Should I really need to factor now, or if I do not have to, then why should I not? And if I have to, then how should I? Ambiguous. There is nothing is crystally clear. So this is what we need to remember as valuation professional, and that is our biggest challenge. What is our biggest challenge? Our biggest challenge is that we live in a world which is called VUCA world. VUCA is volatile, uncertain, complex, and ambiguous. That is what we need to constantly remember. And friends, please remember, let me sound this to you. Why do I repeat? I repeat purposely because awareness is key to a lot of answers in life. Awareness is key to solutions to many problems in life. In life, we face problems because we are not aware. The moment we become aware, we start finding the solutions automatically. So remember one thing, and that is we live in a VUCA world. VUCA, volatile, uncertain, complex, and ambiguous world. Now, moving to the further changing and emerging scenario in this country, as valuation professional, we need to understand the economy of the country in a very systematic manner. We not only need to understand the present and the future, and we also need to understand the past. Because all said and done, and I'm sure friends, you would remember when you would be preparing for your valuation exam, that we all did analysis, and that was known as EIC analysis. Now, what is EIC analysis? EIC, your economy, industry, and company. So, let us look at the changing and emerging scenario as far as the economy is concerned. Now, if I have to talk about economy of our country, I would divide the economy of this country in 5 phases. The phase number 1 starts from 15th August and it ends on July 1991. The phase number 2 starts from July 1991 and it ends on April 2014. Phase number 3 starts from May 2014 and ends with 2019. And the fourth phase, I would say the year 2020. So the year 2020 by itself was completely a separate phase in itself. And the fifth phase of India's economy, I would say, starts from today. I would say it starts from the year 2021. And this is what I intend to do with you now, friends. Take you through all these 5 phases of India's economy. Because for us to know as to where we have to go, we also need to keep on looking in the rear mirror of the car that we are driving. So let's look at them one by one. The first phase of India's economy starts from 15th August 1947 when we got independence. Now friends, if you would recollect, we got independence in August 1947, and there was another country which was also getting independence in the same year, and that was Japan, which got independence in May 1947. Now, if you compare economy of India and economy of Japan, you can see a big contrast. And what is the contrast? Contrast is, though both the countries got independence around the same time, one country is supplying metro trains to another country, which also got the independence in the same year. A question that must come to our mind as to why did that happen? Why is that Japan, that got independence in 1947, is a developed country, and why we, who also got independence in same 1947, are still trying to struggle to become a developed country? Now, there are many reasons, but we need not go through all those reasons. But one factor which stands apart, and that is, unfortunately or incidentally, knowingly or unknowingly, intentionally or unintentionally, the kind of policies that we followed in this country post 1947, unfortunately, were not oriented towards the economic growth. Those were more towards the political growth. So what we did in this country, unfortunately, post-independence, instead of having primacy of economics over everything else, what we had in this country was primacy of politics over economics. And please remember, if there is a primacy of politics over economics, then everything else is bound to suffer. And that is what exactly happened in this country. Unfortunately or incidentally, focus of our people was on how to come back to the power again and again, rather than working on how to improve plight of the people. That Japan did. Unfortunately, the kind of policies that we pursued in this country post-independence, because of the primacy of politics over economics, what we developed in this country was the culture of corruption. And because Japan pursued the policy of nation building, and therefore there the focus was on character building. And that, friends, was the differentiating factor between the growth of Japan and between the growth of India. So primacy of politics over economics led to a situation where from 1947 to 1991, where we were. And let me tell you, friends, the month was June 1991. What was the economic situation of our country? Economic situation of our country was that our forex reserves were just enough to take care of our import requirements of 3 months. We had no money left. We were about to tell the world we are insolvent, we are bankrupt, we can't pay you, we have no money, please excuse us. Now, this is what we need to understand. This is what we need to remember, and remember it very, very clearly, friends. 1947, we gained independence. 1991, what did we had in our hand? We had international bankruptcy. And why was that? Why was that? That was because the message that we need to understand doesn't really matter whether it is an individual or it is a company or it is a country. If you don't create value, if you don't earn income, you are bound to become bankrupt. You are bound to become bankrupt. Primacy of politics over economics, value creation was thrown out of the window. Growth of the economy was thrown out of the window. Instead of generating internal resources and flaring the growth of the economy with the internal resources, because there was no focus on the economy, there was a lot of money had to be borrowed. So 1991, June was the month, and we were about to declare to the whole world that we have no money, please excuse us. But two things this country has never done, and we are really so proud of this fact. Number one, never in the history of this country India has ever attacked any country. 5000 साल की जो हमारी हिस्ट्री है उसमें हमने कभी भी किसी देश पर हमला नहीं किया. एंड नंबर टू, वी हैव नेवर डन, हमने कभी किसी के आगे घुटने नहीं टेके, किसी क्राइसिस के आगे घुटने नहीं टेके. सो व्हेन our forex reserves were just enough to take care of import requirements of 3 months, when we have no money, so we said no, we will not declare ourselves bankrupt or insolvent, we will fight it out. We went to IMF, we went to World Bank, and we told them our problem. World Bank and IMF said, all right, we will help you because that is what our job is, but what is the guarantee that the money that we give will come back to us? We said, okay, tell us what you want as a guarantee. And World Bank said that the only thing that we can accept at this point in time from you as guarantee is your gold. And friends, to overcome that crisis, 46.91 metric ton gold was flown from India. It was placed with Bank of Japan and Bank of England. Against the security of this 46.91 metric tons of gold, the IMF and the World Bank agreed to help us out. But then they said, wait a minute, your gold is fine as a security, but we are not in the business of money lending. We are in the business of helping the economy. So we said, all right, what do you want now? And IMF said, look, if you continue to do what you have done for all these years, you're not going to be any better. On the contrary, you're going to be deeper in the ditch. So we said, all right, please tell us what you want. And IMF said that what we want is you will have to reform. And friends, this is how in June 1991, we were in crisis. July 1991, under the leadership of Prime Minister Narasimha Rao, this country launched a new set of economic reforms, and this is how a new phase of India's economy started. So the second phase starts from July 91 and it ends with April 2014. तो अब क्या हुआ कि हमने जो 1991 में reforms start किए in our country, as a result of those reforms, what we did, we opened the economy, India's economy, for the world. And to a very large extent, a lot of these controls were removed, and there was no license Raj, which earlier was there. There was no inspector Raj, which earlier was there. So all that was removed as a result of the reforms. The thing that we must remember, that these reforms, unfortunately or incidentally, were not coming as a result of visionary leadership. These reforms that were launched in this country were as a consequence of mandate from IMF and from the World Bank. So we started, things improved, undoubtedly things improved in this country, but not as much as they should have. And why is that so? And that is because even though we launched reforms in this country, the mindset of the people at the hems continued of the same, and that is primacy of primacy of politics over economics. That mindset is still continued, and as a result of that, we arrive in the month of April and 2014. Now, if you look back, you will realize that unfortunately or incidentally, corruption was the hallmark of this period. People were really disappointed, people were really frustrated because what was happening in the economy was corruption, 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 and aspirations of people were not being met. And now starts the phase 3, and that starts from May 2014. Now, the phase 3, the salient features of phase 3, number 1 is initiation of visionary leadership driven all round reforms. From primacy of politics over economics, the clock was set reverse, and the leadership started looking at primacy of economics over politics. So the concern for the people, the growth for the economy was of paramount importance than anything else. From free for people in power to all to be accountable. Now that was the change in the mindset of the leadership, and as a result of that, things started improving, things started becoming better, and it went on till end 2019. Unfortunately, the fourth phase, and that is the COVID phase. The fourth phase is 2020, the year of Corona. Now, this is absolutely a unique year in the economy of not only India but all the countries all over the world. Now, this is absolutely unique. The best thing is, friends, the worst ever crisis faced by anyone in the world, including we in this country. Now, this crisis needed attitude of mutual care and support from all, because this was a problem which was not faced by one person or one state or one family or one society or one city. This was the problem which was faced by everyone across the country, and therefore it needed a solution. It needed a solution that was coming with the involvement and engagement of everybody. Most people did that. Unfortunately, few who were supposed to, they failed, and they failed miserably. They failed miserably. तो ये जो crisis हुई कोरोना की, वो कैसी unique crisis, and that's where involvement of everyone was required. And I'm sure all of you would remember, all across people really came out of their way, and they went out of their way to help all their fellow citizens. But unfortunately, few people who were occupying the leadership positions, they were supposed to have played a more proactive role. Unfortunately, they did not, and as a result of that, this problem got aggravated. But anyway, now past is past, so we can forget about it, but of course we can take lesson from it. Those who did not have enough suffered, and those who had more than enough also could not do much about it. This was the uniqueness of this situation. जिनके पास में कुछ नहीं था, उन्होंने परेशानियां झेली. जिनके पास में सब कुछ था, वो भी कुछ नहीं कर सके. This was the uniqueness of this problem of COVID or Corona. Everyone suffered, economy shrank, yet fundamentals are still intact. And this is something, friends, I'm sure as valuation professional, you must be noticing, I'm noticing, everyone is noticing. Now what is happening? Economy has shrunk, and yet look at the Sensex, it has crossed 48,000. Look at the Nifty, it has crossed 14,000. Now how is that? How is that? Why this paradox? Why this contradiction? And that is what you and I as valuer need to understand. The valuation is not done based on the temporary. Valuation is done on something which is going to happen on sustaining basis. So therefore, if you if you notice, if you study, if you realize, you would find how is that despite the corona crisis, despite the shrinkage in the economy, how is the stock market is doing so well? Now stock market is doing so well because stock market is doing the evaluation based on the fundamentals, and that is what you and I need to remember, because you and I are the valuation professionals. So though the worst is over, more leader with country first attitude are required. This is what I would say as far as the phase 4 is concerned of India's economy. And now we are in phase 5. So phase 5 starts from today. So when I say today, that means with the year 2021. What are the things, what are the unique features of phase 5 of India's economy? Number one, by simple virtue of its size, India's market is the market for the whole world. India is the market for the whole world. पूरी दुनिया अपना प्रोडक्ट बेचने के लिए हिंदुस्तान में आती है. Now this is a big strength for the economy of any country. Therefore, in my view, double-digit growth should not be a surprise. If we have failed to achieve continuously double-digit growth in this country, is not because of anything else. It is purely because of inefficient administration of economy of this country. And that is primarily, as I said earlier, is because primacy of politics over economics. If we would have pursued primacy of economics over everything else, India's economy would have been growing with double digit. And not only it would have been growing in double digit, India's economy would have been already in first 3 as far as the economic growth is concerned. Now what is going to happen in the 5th phase that currently we are in? Enhanced all pervasive good governance to follow. Now that is what we need to remember. As valuation professional, please remember, you and I need to have this confidence, you and I need to have this constantly in our memory, that the evaluations that we would do, it's not that I do the evaluation and matter is over. No, my evaluation report is subject to scrutiny. And that subject to scrutiny by whom? Subject to scrutiny by my RVO, subject to scrutiny by IBBI, subject to scrutiny by the client himself, subject to scrutiny by the agency for whose purpose I am submitting my evaluation report. And therefore, I need to constantly remember that the corporate governance, good governance in this country is going to be very, very strong. And as a matter of fact, we, the valuation professionals, are going to be the media of bringing in good governance. And that is what we have to contribute to very immensely. Accountability for all professionals, including you and me. And we also need to remember, no free lunches. Massive digitization leading to removal of inefficiencies from the system. That is what is going to happen. Already has happened. I'm sure. The examples are so many. Why Google is getting such huge valuations. Why a small company like Swiggy is getting so huge valuations, or Flipkart, or all these companies. Why are they getting such huge valuation? Why TCS is such a high cap company? Is all because what these companies are doing. These companies are helping their clients remove the inefficiencies from the system. So with the digitization, more inefficiencies would be removed from the system, and that is what we need to remember as the salient feature of 5th phase of the economy. Continuing major push to infrastructure growth to help 5 trillion economy target. From culture of corruption to culture of national pride is going to be the new thing as we enter the 5th phase of the economy. From profiteering to value creation is going to be the focal area. So gone are the days where people would try to become rich by doing profiteering. more and more as we go, more and more digitization, more and more good governance, and we would realize that there would not be any scope for profiteering. You add value, you create value, you get benefit for it. But merely taking advantage of inefficiencies of the system is not going to help you, because this is how the whole economy is going to work. Shift from local to global. All this time we were talking about local to global. Now there is going to be shift from local to global. The shift is going to be local, vocal, global. Now that is what the Prime Minister also spoke some time back. Now focus on 5 trillion economy, a source of opportunities as well as challenge for all. Now this is the hallmark. These are the salient features, friends, of the 5th phase of India's economy. That is what you and I need to remember, because you and I need to be a part of this progress which is happening. So what are the challenges? What are the challenges in changing an emerging scenario? Challenge number 1, more challenges, more disruptions than ever seen in the past, requiring more innovations across the board. So as we enter the 5th phase of the economy that starts from 2021, we need to be prepared for all kinds of disruptions. So there will be more disruptions, and remember, more the disruptions, more the innovation got to be there. So, and remember, the disruption will not only happen outside, disruption will happen in my profession also, and I need to be constantly thinking about it as to what can go wrong, what disruption can happen in my profession, how do I gear up myself, how do I prepare myself for those disruptions. Ever increasing expectation of client for quality of valuation. Gone are the days the client will come and say, I want valuation to be done, and this is what it is, either you do it or I'll go to somebody else. The world is going to be competitive, the corporate governance is going to be very severe, and therefore transparency at every level is going to be of the highest order. And as a result of that, there is going to be ever increasing expectation of client for quality of valuation. That means the valuation that you and I do for the client has to be so good that he should not face any problem tomorrow, nor I should face any problem tomorrow. Challenge number 3, keeping pace with technology in ever digitizing world. All of us who are, or most of us who are part of the valuation professionals community, are in the average age of 45 plus, and therefore, and we are quite well settled. Since we are quite well settled, there is a good possibility that we tend to be complacent, and when we tend to be complacent, there is a full possibility that we may not really be so much open to new learnings, and that is a big challenge in the ever digitizing, rapidly digitizing world, and that is what we need to remember. Challenge number 4, global demand for high quality valuations. Size does matter. So as the global economy is opening, and it is going to open even with much bigger a force, so demand for the valuations will not only be coming from India within the country, but the demand for valuations will also be coming from outside India. But remember, for the people asking for valuations from outside India, for them size does matter. So if you and I remain small, there is a full possibility that we will not get those big assignments where we would really be able to use our skills, understanding and knowledge in a big way. So what we need to do, we need to gear up ourselves for those big assignments, and that means we need to ensure that we grow big in size. Challenge number 5, speed, appropriateness and accuracy of valuation. The client is not going to give you a time of 2 months, or not going to give you time, you and me, for 2 months, 3 months, 4 months, 5 months for the evaluation. He will come, ask for the evaluation, discuss the matter with you and say, can I get it yesterday? Now that is the kind of expectations that the clients will have as far as the speed is concerned appropriateness is concerned, and accuracy is concerned. Challenge number 6, continuous need to keep update and honing valuation skills. Things are changing rapidly in terms of technology, in terms of technicals, and therefore that is one challenge, challenge number 6. Challenge number 7, adherence and promotion of business ethics and good governance. We need to constantly remember that the provision for valuations in this country have been brought by the government of India, not because the government of India thought of giving another stream of revenue to the cost accountants, chartered accountants, company secretaries, and the lawyers or and the MBAs. No, that is not the intent of the government of India. The intent of the government of India is the chartered accountant, cost accountants, company secretaries, lawyers, MBAs, they are professionals and they would act professionally, and therefore with their commitment and dedication they would help the government to have a better corporate governance, better governance in this country, because better governance in this country is in the interest of everybody. So that is challenge number 7, adherence and promotion of business ethics and good governance. Challenge number 8, expectation of very high degree of professionalism. We are professional and therefore everybody would expect us to be professional, and of course professionalism is a subject by itself but I think if we understand the word professional, professional means what? Means this, just because I'm a company secretary or chartered accountant or cost accountant or lawyer or MBA, do I become a professional? The answer is no. I become professional when I profess what? When I profess ethics, when I profess governance, when I profess values, when I can adhere with them, then only I can call myself as a professional. And that is what is the expectation from across the clients all over the world today. Challenge number 9, overemphasis on market approach requiring adherence with the income approach. And I'm sure you can understand. So what is happening today? Look at the Sensex, look at the stock market. All the companies, most of the companies are running at their all-time high. And therefore, when a client comes to you and he will ask you that give me the valuation, because I am making a same kind of product which Google is making. I am making same kind of product which TCS is making. I am doing same activity which Infosys is doing. I am doing same activity which Wipro is doing. So I am doing same activity which Flipkart is doing, or I am doing same activity whatnot. And they would come and say that since I am doing the same activity as this company is doing, apply the market approach and therefore give the same kind of valuations as these companies are getting. Can you do that? Answer of course is no. Similarity does not mean similarity of the activity. Similarity means similarity in each and every respect. In terms of product, in terms of life, in terms of volume, in terms of profitability, in terms of reach, in terms of geography, every respect. So therefore, from the client side, there would always be demand, there would always be an expectation that use the market approach, because market approach tends to be more beneficial as far as the client is concerned. But can we really do that? As a matter of fact, more the urge by the client to insist on market approach, more is the need to adhere with the income approach, because income approach, remember, is the ultimate. Income approach is the fundamental. Income approach is the fundamental. Why? Because cash, ultimately what is the value? Value is nothing but a product of cash. If there is no cash, there is no value. There is value only if there is cash. Even if somebody is using market approach, remember, he is using market approach because he is able to see some cash. If the cash is not there, there is no value. So therefore, the challenge number 9 is overemphasis on market approach requiring adherence with the income approach. Challenge number 10, need to constantly innovate to match client's expectation. Challenge number 11, need to have a strong hold on the intermix of derivatives, index, IFRS and valuation. Now friends, I am sure all of you would have studied index and you would realize that today tremendous scope for valuation is emanating from the indices, and I'm going to share with you as to which are the indices that would require fair value measurement. And who will do this fair value measurement? This fair value measurement will be done by you and me, and therefore it is absolutely imperative for all of us to have a very good grounding as far as derivatives are concerned, as far as indices are concerned, and as far as valuation is concerned, because there is a good connectivity, deep connection between the derivatives, indices, and valuations. So if you really want to take your practice of valuations to a very high level, make sure that you are ready for this 10th challenge, and that is to have a very strong hold on this intermix of derivatives, indices, IFRSs, and also valuations. And friends, the challenge number 12, urge to follow easy money. I am part of the profession, and therefore I can take this liberty to discuss with you, to speak to you, that there is always an urge to go for an easy money. छोटा काम है, जल्दी पैसा मिल रहा है, ज़्यादा कुछ करना नहीं है, तो there is a tendency go for it. Nothing wrong. Nothing wrong. What is the problem? The problem is easy money deprives us of good money. Because if I keep myself occupied all the time with the assignments that are giving me easy money, now what is going to happen is, by default, I will not be spending as much time as it is required on myself in honing my valuation skills, which will help me to handle more complex valuation assignment. The cash will be coming in, the growth will not be coming. And remember, growth is also important. As a matter of fact, growth is much more important than merely the cash. So friends, these are the 12 challenges that I see in the emerging scenario, and then I would also like to discuss with you few specific challenges which are directly related with the valuation. So valuation से related, what are the challenges? Challenge number 1, which is specific to the valuation. Challenge number 1 is, in 2020, economy has shrunk, yet Sensex is at 48k, Nifty is at 14k. It is perplexing. It is perplexing. IMF, opposition, all the credit rating agencies, the World Bank, everybody has spoken about the decline in India's economy. Notwithstanding talks by everyone of decline in the India's economy, what you are seeing at the stock market is the Nifty is at 14k, Sensex is at 48k. So how is that happening? That is perplexing, and that is what you and I need to understand. That is what you and I need to understand, because ultimately, remember, the Sensex going to 48k, Nifty going to 14k, what is it? It is nothing but valuation. Valuation of what? Valuation of the shares. Share of whose? Share of companies. Meaning what? Meaning somebody is doing the valuation of companies and arriving at those prices. The question is, how is that? Despite the decline in the economy, market going up. That is challenge number 1, as far as the valuations are concerned directly. Challenge number 2, what should I more depend on? So in a scenario where the stock markets are on fire, economy is on decline or has shrunk so far, of course now it is coming back. So economy in 2020 has been on the decline. The challenge that comes to my mind is, what should I depend more on? Should I depend more on the income approach? Should I depend more on the market approach? Or should I depend more on the asset approach? Now that is another challenge that you and I have to face. Challenge number 3, what cost of capital should I take? So if I have to use discounted cash flow method, more often than not, I would use discounted cash flow method. So if I have to use discounted cash flow method, what should I take as the cost of capital? Considering shrinkage of economy, it should be low, isn't it? So if economy नीचे जा रही है, so the discounting factor that I should use, the cost of capital that I should use must be low. But considering the stock markets at all-time high, I should use a cost of capital which is high. Now remember, this is an absolutely unprecedented paradox. Absolutely unprecedented paradox. So what is happening is, since the economy has shrunk, and therefore there is a need for me to go for cost of capital which is on the lower side. But at the same time, since the stock markets are on fire, and therefore there is a need on my part to take a cost of capital which is on the higher side. Now this is a dilemma, friends, that you will have to answer by yourself. So that's challenge number 3. Challenge number 4, relating to the valuation per se. What kind of precautions do I take in cash flow forecasting in view of COVID effect, right? So obviously my cash flow projections for the purpose of DCF in the normal case would be different, and in the COVID scenario they are bound to be different. How do I factor that situation in my cash flow projections? That is what I need to think. But here, friends, again I can help you, I can give you a clue. The clue is going to come from where? Clue is going to come from the first thing that I discussed with you in the very beginning. The clue is going to come from the first thing that I discussed with you. And what did I discuss with you in the very beginning? I discussed with you as to the purpose of valuation is to find fair value. So now the moment you know that I have to find out the fair value, you will be able to automatically decide as to what should you do for ensuring that your cash flow projections reflect the correct situation. Challenge number 5, how do I make my cash flows risk adjusted? And challenge number 6, do I need to consider COVID effect, or it should be ignored, something of the past? Now that the COVID is almost done, I mean when I say almost done, it means, as we can see, the current situation in the country is much more comfortable, much more better, and plus the vaccine also has been approved, and therefore there is a full possibility that sooner than later, hopefully, things would be much better. So therefore, when I do the projections for the purpose of DCF, what do I do? Do I take the COVID in my cash flow projection, or do I ignore it? Now these are the challenges, friends, as far as valuation is concerned, specific challenges relating to valuation. Now, as I said earlier, I would also like to discuss with you future of valuation profession. I think in my view, sky is the limit. Sky is absolutely the limit. As a matter of fact, time will come, and I'm sure must be happening with many of you, most of you. You must be already flooded with valuation assignments, as much as you may not be having enough time to have your lunch or dinner. But please remember, don't miss your lunch and dinner, have it on time. Of course, simultaneously keep on doing your assignments as well. So the future for valuation profession, sky is the limit. Why? Because there is ever growing landscape of valuation locally and globally. Number 2, growing regulatory requirements under Companies Act, Income Tax Act, FEMA, SEBI, directions by court for dispute resolutions, and also for arbitration or liquidation value assignments. So there is a growing regulatory requirement under different statutes. And I'm sure, friends, one more thing that you must have noticed. Earlier, the valuations were required to be done by the merchant banker. And there is a major shift as far as who should do the valuation. Now, as far as the Companies Act is concerned, all the valuations have to be done by the registered valuer only, that is person like you and me. Progressively, even SEBI also has been shifting for the valuations to be done by the registered valuer. As much as there is a provision in the draft valuers bill that once that bill becomes a law, all the valuations under all the statutes in this country will need to be done by registered valuers only. And that is the reason, friends, I say that the sky is the limit as far as the scope is concerned. But there are many challenges, 18 of them I have already spoken, and those challenges we will need to be prepared for. And if we are prepared for those challenges, I can tell you that for growth we really do not have to worry about. And we all know it further. We all know that under the IBC also, you have the requirement of, so as soon as the IRP or RP is appointed, he has to appoint two registered valuers, and plus there is a requirement for valuation under the IBC for the PEFU transactions. Then of course today, because of the independent director, which have become mandatory in so many cases, as we all know, now these independent director, and fortunately again there is a good development. And what is good development as far as the independent directors are concerned? I'm sure many of you must have already done it. Now if a person has to be independent director on the board of a company for whom appointment of independent director has become mandatory, now this person has to be a professional who has passed the IICA's exam of independent director proficiency test. And these independent director, remember, are very conscious, and they will not let any transaction happen by the entity on whose board they are without letting that company having done a proper valuation by a registered valuer. So these are the areas from where the scope is coming as far as the valuation is concerned. And finally, friends, Ind AS and IFRS. Ind AS, of course, for the Indian companies, IFRS for the European companies or companies across the globe. There are many standards. There are many standards which demand, which require, which mandate that companies to whom indices have become mandatory, companies to whom IFRSs are mandatory. Now these companies perforce will have to have the fair value measurement done of the assets and liabilities of those entities under different indices. And I'm going to share with you, friends, number one, I would like to share with you is, we all know that there are all put together 39 standards, 39 indices. Indices, as we all are aware, are a combination. Really speaking, indices that we have in our country are the adopted version of IFRS. In IFRS, there are two series. One is International Accounting Standards, which was the old series, and the other is IFRS, which is the new series. Out of the old series, as it stands today, 23 standards are still in force. And besides these 23 accounting standards that are still in force as per the International Accounting Standards, the first series, in addition to this, there is a second series, and that is IFRS. So IFRS, the new series, and International Accounting Standards, the old series, put together today have got 39 accounting standards. 39 accounting standards. And in India, the government has been going in a phase-wise manner, and as it stands today, all the companies whose net worth is more than 250 crores, and I'm repeating it once again, all the companies whose net worth is more than 250 crores, for all such companies, indices have become mandatory. That means these companies will need to draw their financial statements as prescribed under these 39 standards as may be applicable to these companies. So, and remember, once the index become mandatory to a company, not only this company will have to draw its financial statements as per the indices, even the holding company, subsidiary company, associate company, joint venture company of such a company will also need to prepare the financial statements which got to be as per the indices. So there are all put together 39 standard Indian accounting standards. So IFRS में कहें तो 23 of the old series, 16 of the new series, put together 39 accounting standards. Now these 39 accounting standards in India have been adopted with some carve-outs and carve-ins. So depending on the Indian situation, some changes have been made somewhere, in some of these standards, and but those adopted IFRSs in India are referred as Indian accounting standards. As much as the numbering also has been kept same, so that there is a consistency, so that there is a harmonization, so that there is a easiness of the reference. So 39 standards are there in force today as far as Indian accounting standards are concerned. Out of that, all put together, practically 19 accounting standards, 19 Indian accounting standards require the entities to whom the Ind AS have become mandatory, require that these entities must obtain, must state assets and liabilities under different indices, which is based on fair value. So that means what? That means somebody has to do the valuation of the assets and the liabilities of such an entity to whom index has become mandatory. And who will do this valuation? This valuation will be done by a registered valuer. It will be done by a registered valuer only as per the Companies Act. So which are these standards? Let me tell you. The first one is Ind AS 1, which is on presentation of financial statements. Number 2, Ind AS 29, which is financial reporting in hyperinflationary economies. May not be applicable in our case, but it is there, which is covered as part of the indices. Ind AS 32, which is on financial instruments presentation. Ind AS 102, which is on share-based payments. So whenever a company is doing transactions where the payments are being made in terms of shares, so all those transactions will need to be fair valued, and that's where the demand for you and me is there. Ind AS 107, financial instruments disclosure. Ind AS 113, which itself is on fair value measurement. Ind AS 16, which is on property, plant and equipment. Ind AS 19, which is on employee benefits. Ind AS 20, which is on accounting for government grants and disclosure of government assistance. Ind AS 21, which is on the effect of changes in foreign exchange. Ind AS 36, which is on impairment. Ind AS 37, which is on provisions and contingent liabilities and the contingent assets. Ind AS 38, which is on intangible assets. Ind AS 40, which is on investment property. Ind AS 109, which is on financial instruments. Friends, let me tell you, Ind AS 109, which is on financial instrument, is a very, very important index. It runs into almost about 190 pages. 190 pages. But you and me as a valuer ought to have a very good understanding of Ind AS 109, which is on financial instrument. Ind AS 116, which is on leases. Then Ind AS 101, which is on first time adoption of indices. Ind AS 103, which is on business combination. Ind AS 104, which is on business insurance contracts. So all put together, friends, there are 19 accounting standards, a challenge, a big challenge, but at the same time, a big opportunity. Not only a big opportunity, but also how to do the valuation. The strategy for valuation will emanate from the understanding that we have about these standards. So that is what I thought I would share with you. And now let me come to the specifically as to what are these valuation strategies. One, of course, is to have a good understanding of the indices. Let me now focus on what are the valuation strategies in these changing and emerging scenario. Number one, as a valuation professional, please remember what we got to keep in mind is invariably most of us who have become valuation professional, most of us have been earlier practicing as a cost accountant or maybe chartered accountant or maybe company secretary. But basically we have been in our earlier role, we were in the practicing cost accountant. Now, what is the problem? The problem is, as a practicing cost accountant or practicing chartered accountant or practicing company secretary, we tend to develop a different kind of mindset. What mindset? Mindset of being an advisor. So therefore, we tend to think to every situation from the perspective of as an advisor. Now, as valuation professional, the strategy that we need is our thinking has to be as per the thinking of a businessman. Meaning what? Meaning we need to think the way a businessman thinks. So when we are doing the evaluation, we need to look at the evaluation not merely as an advice. We need to look at the evaluation that we are doing as if this project I'm going to do. So that is what we need to remember. And how will a businessman think? How a businessman will think? A businessman, friends, will always think in terms of the purpose of a business. Businessmen will always think in terms of purpose of a business. And remember, why purpose of a business? Because if you know what is purpose of business very well, then decision making for you becomes very easy. And if I ask you this question as to what is purpose of a business, I'm sure all of you will come out with different answers. It is quite possible some of you might say that the purpose of a business is to make profit. But let me tell you, friends, purpose of a business is not to make profit. Purpose of a business is not to make profit. And why do I say this? I say this, and please pay attention. If purpose of a business was to make profit, then you will not see a company called Google. Why? Because Larry Page and Sergey Brin, who are the founders of Google, they made profit in very first few years of their company. And what they would have said, purpose of a business is to make profit. We have made profit. Purpose is achieved. Let us close the business. If the purpose of a business was to make profit, you would not see a company called Google. You would not see a company called Apple. Why? Because Steve Wozniak and Steve Jobs, the promoters and the founders of Apple, they also made profit in very first few years of their operations. And they would have said that the purpose of a business is to make profit. We have made profit. Purpose is achieved. Let us close the business. And if the purpose of a business was to make profit, remember, you would not see a group called Tatas. The Tata's empire that we see today, we would not see that. Why? Because Jamshedji Tata, within few years of setting up the steel plant in Jamshedpur, started making profit. And he would have said, purpose of a business is to make profit. I have earned a profit. Purpose is achieved. Let me close the business. And therefore, friends, I say that the purpose of a business is not to make profit. And why do I say that the purpose of a business is not to make profit? I say so because making profit in business is compulsory. Making profit in business is mandatory. Making profit in business is non-negotiable. If you are in business, you better make profit. If you are in business, you better make profit. If you are in business and you are not making profit, least that you can do is to hand over that business to somebody who can run it and make profit out of it. And that is why I say that the purpose of a business is not to make profit, because profit you have to make. Profit is only a means, it's not end. What is the end? End is to create value. To create value. That means to do something that is going to improve life of the people on this earth. That is the purpose of a business. To make things better today than what they were yesterday is the purpose of a business. Obviously, when you will create value, you will make profit. You will make profit. But you don't run the business because you want to make profit. The real businessman will run the business not because he wants to make profit and enrich himself. The real businessman will run the business because he wants to create value. And why he wants to create value? Because he wants to make a positive difference in the life of others. And that is the purpose of the business. That is what, friends, you and I need to remember. And why you and I need to remember? Because understanding of purpose of a business will help us take decisions just like this. So whenever you are in dilemma next time, ask yourself, if I take this decision, will I create value or will I destroy value? If your answer comes that I will create value, will you have to think second time to take that decision? Answer is no. The moment you think that this decision is going to help me create value, you will go for it. So number one, strategy, think like a businessman. Number two, know how the business operations are controlled. As a valuer, remember what we are doing. We are, as valuers, valuation professional, we are not doing Excel sheet calculations. Excel sheet calculations is a very minor part of the valuation that we are doing. So what we are doing is, we are really speaking as valuer, what we are doing, we are assessing the capabilities and the potential of the company or the asset that we are valuing. How can we do that? We can do that only when we have a good understanding of what is the lifeline of a business. What is the, how to control the business. Why? Because if I have to do a valuation, और जब मैं उसका वैल्यूएशन कर रहा हूँ, जब मैं उस कंपनी को स्टडी कर रहा हूँ, तो मैं क्या चेक करूँगा? मैं ये चेक करूँगा बाकी सारी चीज़ों के साथ में कि ये कंपनी का कंट्रोल कैसा है. How is the control of this company? If this company's control is good, obviously I am going to give better valuation to this company. But if this company's valuations are not good, then I am going to give lower valuations to this company. So control of the operations become very crucial. As a valuation professional, that is what you and I need to know. What you and I need to know? You and I need to know as to what is lifeline of a business. Again, friends, if I was to ask you this question in a live session, obviously you would come out with many answers. But I can tell you, the lifeline of a business is one simple thing. And what that one simple thing is? That one simple thing is cash profit. Cash profit. Remember, cash is not the lifeline of a business. Profit is also not lifeline of the business. Then what is the lifeline of a business? Lifeline of a business is the cash profit. How do you control a business? By looking at the cash profit. You control a business by looking at the cash profit, because if a business is generating cash profit as you would have budgeted, that means this business is on track. This business is going in the right direction. But if a business is not generating cash profit, and please remember why I am talking about cash profit, because cash profit will include everything. So if I focus on cash profit, I do not have to look at the sales. If I focus on cash profit, I do not have to look at the COGS. If I am focusing on cash profit, I do not have to look at the SG&A. If I look at the cash profit, I do not have to look at the fixed assets and the plant and machinery and all those. If I look at the cash profit, that means I am looking at each and everything by default. If a company's cash profit is as per its budgeted figure, that means everything has gone well with this company, generally speaking. Exceptionally, there can be some situations, but generally speaking, everything is going good with this company. So look at the cash profit. Cash profit. Now, what is cash profit? Now, and what is cash profit? Cash profit, friends, is very simple. Profit that you have earned and it is with you. That is cash profit. And why cash profit? Because only thing that will help you in your business is the cash. Which cash? Cash which is coming from the profit. Now please understand here, as valuer, that is what we need to remember. Cash in a business can come from three places. Cash in a business can come from three places. Cash can come from equity, cash can come from debt, and cash can also come from the operations. Can the cash coming from the equity be my lifeline? Answer is no. Can the cash coming from debt be my lifeline? Answer is no. Then what can be my lifeline? What will give long life to my business? What will give long life to my business is not the cash coming from equity, is not the cash coming from debt. It is the cash coming from operations, and that is cash profit. Number 3, strategy for valuation. What is one thing which you do in your approach to valuation which others don't? And that is what you need to find out. That is what you need to find out. What is one thing that you are doing, others are not doing? Because that will give you cutting edge in your valuations. Number 4, how to measure value creation. Whether you should use EBITDA, or you should use OFCF, or you should use ROCE, or you should use EVA for the purpose of finding out value creation. Because ultimately, remember, value of a business will depend as to how much value this business is creating. So if I have to do the evaluation of a business, I need to find out as to how much value this business is creating. Only if a business is creating value, only if a business has the potential to create value, this business will get the valuation. Otherwise, this business will not get valuations. For that, you and I need to know as to how to measure value creation. Number 5, very important, differentiate between certification and valuation. Remember, certification is not same as valuation. Barring few exceptional situations, we as the valuation professionals are supposed to be doing the valuation. Certification can be there in exceptional cases, but not generally. So that is what we need to remember. Certification, differentiate between the certification and valuation. Number 6, if you don't value yourself, then no one will. And that is the strategy that you and I need to deploy. You and I need to be aware of. There is a full possibility कि एक client आपके पास में आता है and he asks you to do a valuation for him, and he asks you to give him a quote, and you say, I will charge you. You study the entire thing, of course. Only after studying the entire thing you come to a conclusion, considering the time and efforts that you will need to put for doing the evaluation of this particular company. You quote a figure of 200,000. Now the client tells you after 2 days that somebody is prepared to do it for me 40,000. Can you do it for less than that? And if you say yes, I will do in 35,000, I can tell you, you are finished. You are finished completely. Because if you don't value yourself, nobody will. And I can also tell you, the moment you tell this person that I will do it in 35,000, his next question will be, I can give it to you if you do it in 30,000. And remember, as a valuation professional, I and you and I add value, create value, help our clients taking good decisions. If you and I don't value it, nobody is going to value. Remember that. Number 7, constant updation of competency and skills. We have to. Number 8, opportunity of making the impact versus source of livelihood. Number 9, valuation is an opportunity for self-optimization. So if you and I have to be really good valuation professional, in my view, friends, I don't look at the valuation merely as an opportunity for earning more money. I look at the valuation as an opportunity of self-optimization. And why do I say self-optimization? That means when I get an assignment, I take this as an opportunity where I would be able to apply my thought, apply my mind, use my intelligence, use my experience, use my expertise, and come out with a valuation which is really going to be something so very creative and conclusive and precise and accurate. So 8th strategy, look at it. 9th strategy, look at it as an opportunity of self-optimization. 10, team and network for matching clients' expectations. So that is what we need to remember. And finally, friends, the 11th point that I would like to add here is expect the unexpected. Expect the unexpected. Now this is the 11th point, friends, that I thought that I would share with you for doing the valuation in the emerging and changing scenario. So friends, with this I come to the close of my session. Thank you so much, and I would be very happy to take, I have left enough time, so I've got almost about 20 minutes left for taking care of your questions. Thank you so much, and it's all open to you now. Thank you.